Yesterday, we got exactly the news the Federal Reserve has been waiting for. Core inflation just hit its lowest level since March 2021. By all traditional logic, the stock market should have celebrated. Instead, the S&P 500 is dropping, and the Nasdaq is following right behind it. Welcome to Market Brief. Today, we are breaking down the disconnect between the cooling inflation data and the market's negative reaction, and what it means for your portfolio as we head into the most important week of the month. Let us start with the data that is driving the narrative this week: the February Consumer Price Index, or CPI. The headline number came in at a 0.3% increase month over month, keeping the annual inflation rate steady at 2.4%. But the real story is in the core CPI. Core CPI strips out the volatile categories of food and energy, giving us a clearer picture of underlying inflation trends. And this is where we saw significant progress. Core inflation rose just 0.2% for the month, bringing the year-over-year number down to 2.5%. To put that in perspective, that is the lowest reading we have seen in exactly 5 years. For the Federal Reserve, this is a massive victory. It shows that their prolonged campaign of restrictive monetary policy is finally suffocating the sticky inflation that has plagued the economy. Energy prices did tick up slightly by 0.6%, reversing a drop from January, but the broader trend is undeniably moving in the right direction. So, if the data is good, why is the market reacting so poorly? To understand the market's reaction, we have to look at the broader context. The S&P 500 has been under pressure all week, and today we are seeing the index drop another 1%. The reality is that the market is not selling off because of the inflation data. It is selling off despite it. There are two main factors at play here. First, we are seeing classic profit-taking. The market has had an incredible run, and investors are locking in gains ahead of potential volatility. Second, and more importantly, is the anxiety surrounding the Federal Reserve. Good inflation data is great, but the market is forward-looking. Investors are no longer asking, is inflation cooling? They are asking, when will the Fed actually cut rates? And right now, the answer seems to be, not yet. The market is repricing its expectations, realizing that a victory over inflation does not automatically mean an immediate return to cheap money. That brings us to the most critical event coming up next week. The Federal Open Market Committee, or FOMC, meeting on Tuesday and Wednesday. Let me be clear, nobody is expecting a rate cut next week. The CME FedWatch tool currently prices in a mere 2.7% chance of a reduction. The Fed is almost certainly going to hold rates steady. But the decision itself is not what matters. What matters is the communication. On Wednesday afternoon, Jerome Powell will step up to the podium, and the market will be hanging on every word. We will also get the updated dot plot, which shows where Fed officials expect interest rates to be at the end of the year. If Powell acknowledges the progress on core CPI and hints that cuts are on the table for the summer, we could see a massive rally. But if he maintains a hawkish tone, emphasizing that the job is not done, the current sell-off could accelerate. We will also be watching key earnings reports next week from General Mills, Accenture, FedEx, and Nike, which will give us a real-time look at consumer spending and corporate health. The bottom line is this: the market is in a holding pattern. The inflation data gave us the what, but the Fed will give us the when. Until we hear from Jerome Powell next Wednesday, expect the volatility to continue. We will be back next week with a full breakdown of the Fed's decision, what Powell actually said, and how it changes the outlook for the rest of the year. If you want clear, organized market analysis without the hype, make sure to subscribe to Market Brief. See you next time.